morning, we're going to cover Chapter 1, Accounting and the Business Environment. First, I want to show you a quick little video. And you will not be able to view this video on Moodle, but you will be able to hear it. Let me go ahead and play.
How are you? I'm Robert.
All right, class. So I hope that that inspired you. So we are covering Accounting 1. This is your first accounting class for most of you, I'm assuming. And like I mentioned, this is accounting and the business environment. In this class, we are going to explain why accounting is important and list the users of accounting information, describe the organizations and rules that govern accounting, describe the accounting equation and define assets, liabilities, and equity. We are going to use the accounting equation to analyze transactions, prepare financial statements, and use financial statements and return on assets, also known as ROA, to evaluate business performance. So first, why is accounting important and who uses accounting? Accounting is the information system that measures business activities. It processes the information into reports and communicates the results to decision makers. This is a diagram showing the Pathways Vision model. This is licensed under Creative Commons Attribution. So this model, we're looking at two different things. So most people tend to think of accounting as being boring. Accountants are boring and dry, so analytical. It's all about numbers, and they can't have any fun. Most people think of accounting as being black and white, a far left or a far right. There's a definitive answer, and really and truly, that is not the case. Most and many times, accounting is not black or white, it is gray. There is a lot of gray. So when we look at this diagram to the right, they're saying accountants are instrumental in helping to create a prosperous society. And so here we see we've got this prosperous society at the top, which is what we are striving to get to. And to get to that prosperous society, we have all of these other little layers here, this climb that we have to make to get up to this prosperous society. So this is all accounting. And accounting is a lot of critical thinking. So for example, if you like to do puzzles or you like to be challenged, accounting would definitely be something for you to get into. So down here we have our economic activity, and from that economic activity, there are a lot of shades of gray. It is not just, left or right, black or white. There's a lot of gray. And so when we're looking at this gray area, because we don't have a definitive answer, we as accountants, managers of the business, we have to come together and make decisions, judgments. So accountants make these accounting judgments, and they are made using useful information. And hopefully we used reliable and useful information, and from that we made good accounting judgments, which will help us to make good decisions. And from those good decisions, we will have a prosperous society, a thriving business, a company that will work and grow and continue to succeed. If those decisions are not good decisions, there will be consequences. And mistakes can be made. If the decision is not a good decision, more than likely the information used to make that decision maybe it wasn't reliable, or maybe it was the wrong information. Maybe it wasn't really useful for the decision at hand. Or maybe we just went with our heart instead of our head. And what I mean by that is, I guess if you think more like an entrepreneur, let's say that you really, 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 really want to own your own t-shirt business. And you go in there and you start this t-shirt business, and it's not making any money. It costs, how you have it set up, it costs you like $30 to make a t-shirt, and you can't sell them for more than $20. But you really want this business, and you're looking at your information, you're looking at your numbers, and you know that it just can't possibly work, but you want this business so bad that you stay in it. That may be a bad decision, right? However, there are other ways around it. Maybe you can find lower cost suppliers, and you can figure out a way to create this t-shirt for $10 and sell it for $20 so that you're making a profit. But if you don't figure out those workarounds in order to be able to make a profit and have a thriving business, the business will cost you and may end up failing down the road. So you definitely want to make sure you're using useful, reliable information to make good decisions, and you are following your decisions based on facts. Because the consequences, they can come from the accounting judgments, like mentioned, or the economic activity. Maybe you start this t-shirt business and you're making the shirts for $20 and you're selling them for $30. So you're selling them for more than you create them for. But all of a sudden, out of nowhere, the demand for these shirts goes down. Let's say more people are out of work, things like that, economic activities, and you aren't able to sell these shirts anymore. Maybe you're selling a fourth of what you used to sell, or you have to reduce the price to sell them, and now that price is the same as what it costs for you to make them, $20, or maybe it's even less, and you just can't sell them for more than that because of the economy. Now, that's where you go in and you think about this and you make the decisions. Do I need to close down shop? What do I do here? I'm not making any money anymore. What do I do? Because if you stick with it and you aren't able to figure out solutions to turn it around to where you are making a profit, then this money to keep your business alive is coming out of your pocket. And eventually those pockets can empty. And so you just want to make sure that you're using good, useful, reliable information, analyzing that information to make your judgments and hopefully make good decisions for your business and even yourself. So accounting is cooler than you think. So this is another video that I have listed here for us to watch. And this is one that I recommend you looking up on your own time if you're not in class, because it does have some value. All right, guys, you've already started, right? So you're here in class, and that means that you've taken at least a step. I'm not going to say the first step because some of you may have gone and gotten other certifications or degrees, but you have already taken a step. You are here, you're in class, you've taken a step towards your future. So accounting is cooler than you think. Decision makers, the users of accounting information. This is on page 3 in your book. Who are those users? Who uses this information? Why would anyone want to look at all these numbers, right? Well, two different sets of people. We have decision making that is financial accounting, and then we also have decision making that is managerial accounting. And financial accounting, it is important for you to know these. Financial accounting, these are your external decision makers. They are the ones that are using this financial accounting, external. And the questions that they are asking when they are looking at your financials is, should I invest in this business? Is this business profitable? Can we lend money to this business? Should we lend money to the business? Can the business pay us back? If we lend them this money, are they going to be able to pay us back? So these are some of the questions that external decision makers are asking themselves when they are looking at your financials. With managerial accounting, this is internal, inside the business. So when you see managerial accounting, think manager. A manager works in the business, internal decision maker. And the questions that they're asking when they're reviewing the financials is, how much money should the business budget for production? Should the business expand to a new location? And how do actual costs compare to the budgeted costs? Decision makers, the users of accounting information. Here we are breaking down a little bit further financial and managerial accounting. And financial accounting provides information for external decision makers, such as investors who own a portion of the business, creditors to whom the business owes money, and taxing authorities to whom the business owes taxes. With managerial accounting, managerial accounting provides information to internal decision makers. Types of accountants. We have many different types of accountants. You can have CPAs, certified public accountants. They serve the general public. You have CMAs, certified management accountants. They specialize in accounting and financial management knowledge and work for a single company. There are also other types of accountants out there, many. And then as far as accounting positions, you have public, private, and governmental. The accounting profession. So these have actually changed a little bit, increased. And so we have different positions here that are listed. By the way, accounting is in high demand for anyone who's considering getting an accounting degree, becoming an accountant. Accounting is in high demand right now. And so it could definitely, if you are interested in it, you could definitely, your chances are much better as far as getting in as an accountant somewhere, because like I said, it is in high demand, and salaries are pretty good for the profession. So there are different types or different positions. The first one here, they're listing out a controller, a financial analyst, business systems analyst, tax accountants, auditors, cost accountants, and bookkeepers. I'll let you read the rest, but these are just some of the accounting positions that are out there. There are several. So objective 1.2, describe the organizations and rules that govern accounting. So our governing organizations, we have FASB and the SEC. And FASB is the Financial Accounting Standards Board. It oversees the creation and governance of accounting standards. The SEC, Securities and Exchange Commission, oversees the U.S. financial markets. GAAP, Generally Accepted Accounting Principles. These are the accounting guidelines. GAAP is the main U.S. accounting rule book. GAAP is created by and governed by the FASB, and accounting information to be useful must be relevant and faithfully representative. An organization that stands apart as a separate economic unit follows the economic entity assumption. And different types of business organizations. We have sole proprietorships, partnerships, corporations, limited liability companies. The economic entity assumption. So this diagram here is showing us different business organizations. And so we're starting with the sole proprietorship. And with sole proprietorship, this is a business with a single owner. There's one owner, they are the proprietor, and the sole proprietorship terminates at the owner's choice or at the owner's death. The owner is personally liable for the sole proprietorship. For a partnership, this is a business with two or more owners and not organized as a corporation. So again, it has two or more owners who are called partners. It terminates at a partner's choice or death, and the partners are personally liable. A corporation is a business organized under state law that is a separate legal entity. There are one or more owners in a corporation, and they are called stockholders. A corporation their life is indefinite. They last forever. And stockholders are not personally liable for the corporation. With a limited liability company, LLC, a company in which each member is only liable for his or her own actions. So in an LLC, each member is only liable for their own actions. They can have one or more owners, and members, they're called members or partners. The life of an LLC is indefinite, and members are not personally liable. For taxation purposes, a sole proprietorship is not a separate taxable entity. The owner pays tax on the proprietorship's earnings. And it is normally these are small businesses. Partnership is not taxed. Instead, the partners pay tax on their share of the earnings. And the type of business, a partnership is professional organizations of physicians, attorneys, accountants. These are normally the types of businesses that are partnerships. A corporation, they're separately taxable entity, and the corporation pays the tax. And these types of businesses are normally large multinational businesses. And then an LLC is not taxed. Instead, the members pay tax on their share of earnings. And with the LLC, an alternative to the partnership. So it's similar to a partnership, but it's an alternative to the partnership. GAAP. With GAAP, we have generally accepted accounting principles, and we have economic entity assumption, the cost principle, going concern assumption, and monetary unit assumption. Make them back one. Kind of go into these a little bit more. So let's see here. So for example, the cost principle, this is a principle that states that acquired assets and services should be recorded at their actual cost. The economic entity assumption requires that each organization be separate from other businesses and from the owners. Going concern assumption assumes that the entity will remain in operation for the foreseeable future. And monetary unit assumption is the assumption that requires the items on the financial statements to be measured in terms of a monetary unit. It should all be measured in money. The International Financial Reporting Standards, IFRS. IFRS is a set of global accounting guidelines formulated by the International Accounting Standards Board. They use principle-based standards. They are used or required by more than 120 nations and published by the Internal Accounting Standards Board, or IASB. And IASB is the private organization that oversees the creation and governance of international financial reporting standards. Ethics in accounting and business. An audit is an examination of a company's financial statements and records. And the SOX, the Sarbanes-Oxley Act, it requires companies to review their internal controls and take responsibility for the accuracy and completeness of their financial reports. So we have a couple of questions here listed in the book on page 11. So we're going to just kind of go through these real quick. And I actually just realized I skipped some from page 5. So I'm actually going to have you go back to page 5 real quick. And there's a try it listed here. And we're going to run through these. So it's asking us to match the accounting terminology to the definitions. So number 1, we have certified management accountant. And the answer to this one is E. So certified management accountants are certified professionals who work for a single company. Accounting, number 2, is A. Accounting, the information system that measures business activities, processes that information into reports, and communicates the results to decision makers. Number 3, D, managerial accounting. Managerial accounting is the field of accounting that focuses on providing information for internal decision makers. Number 4 is B. Certified public accountants are licensed professional accountants who serve the general public. Number 5, F. Accounting, financial accounting is the field of accounting that focuses on providing information for external decision makers. And number 6 is C, creditor, any person or business to whom a business owes money. So that was all on page 5. Now on page 11, it says again to match the accounting terminology to the definition. So number 7 is D, the cost principle states that acquired assets and services should be recorded at their actual cost. Number 8, F, GAAP, generally accepted accounting principles, is the main U.S. accounting rulebook. Number 9 is I, faithful representation requires information to be complete, neutral, and free from material error. Number 10, C, the SEC oversees U.S. financial markets. Number 11A, FASB oversees the creation and governance of accounting standards in the United States. Number 12H, monetary unit assumption assumes that items on the financial statements are recorded in a monetary unit. Number 13B, economic entity assumption requires an organization to be a separate economic unit. Number 14G, going concern assumption assumes that an entity will remain in operation for the foreseeable future. And number 15E, the IASB creates international financial reporting standards. All right. So now we are going to describe the accounting equation and define assets, liabilities, and equity. So the accounting equation, it is assets equal liabilities plus equity. And it's the basic tool of accounting, measuring the resources of the business and the claims to those resources. We need to remember that the accounting equation is an equation, so the left side of the equation always equals the right side of the equation. So I do have another video to watch, and I really like this video, actually. I feel like it is really good. I really hope that you could see this. For those of you that are rewatching this video later, please pull it up. All right. So that was just a little video explaining a little bit more on debits and credits, which we will get more in detail. So, an asset is an economic resource that is expected to benefit the business in the future. Some examples we have are cash, merchandise inventory, furniture, and land. Liabilities are debts that are owed to creditors. Many liabilities have the word payable in their titles. For example, accounts payable, notes payable, and salaries payable are all liabilities. Equity, this is the owner's claims to the assets of the business, also called owner's equity, and it increases in equity. The increases in equity result from owner's capital or owner contributions and revenues. Decreases in equity result from owner withdrawals or dividends and expenses. So this, again, we have the accounting equation, and we've actually expanded it to show the components of equity. So as mentioned earlier, the accounting equation is assets equal liabilities plus equity. But then within equity, we have other accounts. So in this expanded accounting equation, we see here that equity is comprised of owner's capital minus owner withdrawals plus any revenues of the business minus any expenses of the business. Net income. You have net income if your revenues are greater than your expenses. And when you think about this in your personal life, you could relate this to your personal life. Okay, so paycheck, you get paid $500 a week, and your expenses for that week are $400. Well, your revenue was $500, your expenses were $400, so you have a net income of $100. Net loss. Let's say that your revenues, your paycheck is $500 a week, and your expenses are $700 a week. Well, your revenues are only $500, your expenses are $700, so your revenues are less than your expenses, so you have a net loss of $200. So we do actually have another try it here. I will actually let you guys work that on your own time. This is number 16, and then once you have completed that, submit that to me. I will review it and check your answers. This is on page 13, try it number 16. All right. So now we are going to talk about how to use the accounting equation. And I actually need to make a little note really quick. So give me just a second to pull this up. How are we on time, by the way? Let's see. Okay, we're pretty good. Perfect. Okay. So I did make that note. All right. So learning objective 1.4. Use the accounting equation to analyze transactions. So how do you analyze a transaction? What is that? What does that look like? What does that consist of? So a transaction is any event that affects the financial position of the business, and it can be measured with faithful representation. So here we have an example. Is this a transaction? when you buy a computer for the office and you pay $2,000 cash, is that a transaction? Well, you're receiving the computer and you're paying cash for that computer. So yes, you have just made a transaction. Two different things have exchanged. You've exchanged money for a computer. What about when you hire a new employee? No, that is not a transaction. Hiring a new employee is not a transaction. Yes, you will be paying them in exchange for their work, but that is not a transaction. So how do you analyze it? Transactions can be analyzed in 3 steps. Step 1, we have to identify the account and account type. Step 2, we have to decide if each account increases or decreases. And step 3, we need to determine if the accounting equation is in balance. So remember, we said assets equal liabilities plus equity. The accounting equation has to balance. So here we have transactions that we're going to run through starting on page 14 in the book. And so we have Sheena Bright, who contributes $30,000 cash to start a new business as a sole proprietor. The business is Smart Touch Learning, and the effect of this transaction on our accounting equation is as follows. So she invested $30,000 cash to start the business, so the cash assets in the business are going to increase by $30. And this is an owner investment, so her equity account is also going to increase by $30. I'm sorry, $30,000. It's a big difference right there. So then for transaction 2, there's a purchase for land. So Smart Touch Learning purchases land for an office location, and they pay $20,000 cash. So our business has paid $20,000 cash to purchase land. So our cash is going to go down. So our asset cash account is going to decrease by $20,000. So we see we started with $30,000. We're taking the $20,000 out. So now we are left with $10,000 cash in our asset account. And we exchanged that $20,000 for land. Land is also an asset. So our assets for land will increase by $20,000. So if you look here, you'll notice that our assets did not change. Our total assets did not change, right? We spent $20,000, which reduced our assets, but then we received land valued at $20,000, so that increased our assets back. So our total assets are still $30,000. However, what happened is that the amounts moved from one account to the other. So we took that $20,000 out of our cash account and placed it in our land asset account. And all of this transaction took place within our assets on the left side of our accounting equation. And because this balance did not change, it remained $30,000, our equation still balances because our equity also has a $30,000 balance in it. So remember, like we mentioned, the left side has to equal the right side. And it does. 10,000 plus 20,000 equals 30,000. And then we have 30,000 on the other side as well. Transaction 3, purchase of office supplies on account. So Smart Touch Learning buys an office supplies on account, which is a liability called accounts payable. And they agreed to pay $500 within 30 days. So to see this within our accounting equation, we look down here, we have our office supplies, which is an asset account, and we've increased office supplies by $500. But then we paid it on account, and when you see the word on account, the words on account, this is a liability. On account is it's kind of like a credit. We're using a credit card or something like that. It's to understand what it is. On account is like when you go to a store, let's say you're a contractor and you go to Home Depot and you say, hey, I need to get I need to get some wood for a project that we're working on. Can you put the cost of the wood on my account and I pay you later? So Home Depot says, yes, that's fine. You're a contractor that's been with us for a long time. We trust that you're going to pay us for this wood. We understand that you've sent your employee to come pick it up and he's not available. He's not able to pay for it right now. So we're going to put this wood on your account and you can pay us later. So we go ahead and we take that wood, in this case, office supplies, and we're going to pay for it later on account. So this is a liability. We owe this money. It is a bill that we owe to the company that we purchased the supplies from. So it's going to fall within our liability section, which is on the right side of the accounting equation. And so our assets increased by $500 and our liabilities increased by $500. Then we earn service revenue by providing training services for clients. The business earns $5,500 of revenue and collects this in cash. So we see here we've collected $5,500 in cash. So our cash account increased and we earned this in revenue. Revenue falls within our equity section. So we have service revenue shown to the right and our revenue account increased by the same amount. And so our equation will still balance. Then we earned the service revenue by providing training services for clients. The business earns $5,500 of the revenue and collects it in cash. So we see here we've got our service revenue, $5,500. And then we pay $3,200 in cash expenses. We pay $2,000 for office rent and $1,200 for employee salaries. So when we go in and we're looking at this, our rent expense falls under equity. So we're going to subtract our rent expense of $2,000. And we have salaries that we paid out. Our salaries also will fall under equity. So we're going to subtract out our salaries expense of $1,200. And that was paid in cash. So our cash account is going to decrease for the total amount that was paid out. Then we pay $300 to the store from which it purchased the office supplies. So we're making a $300 payment on our office supplies. So that means that we're going to decrease our cash account by $300. And we're also going to decrease the liability for accounts payable by $300. In transaction 8, we now collect $2,000 from the client from transaction 5. So we're collecting $2,000, so our cash account is going to increase. And our accounts receivable is going to decrease because we've collected this money from the client. And then our owner decides that she's going to withdraw, hold on, let's see, 5,000, yes. So there's a typo here, but she withdraws 5,000, this is on page 17 in the book, from the business. So the cash is going to go down by $5,000, and the owner withdrawal account will also go down by $5,000. And this is just a diagram showing the analysis, all of the transactions that took place, and showing that we still balance our assets equal our liabilities plus our equity. There is another try it in your book on page 18. So I'm just going to make a note here of this as well. So I want you guys to try it on page 18 is try it number 17. Please do that try it and send that try it to me as well. All right. So learning objective 1.5, prepare financial statements. How do you prepare financial statements? So here we've got a listing of our financial statements. We have the income statement, statement of owner's equity, balance sheet, statement of cash flows. And the income statement provides information about the profitability for a particular period of the company. It's prepared using revenues and expenses. So we take our revenues minus our expenses, and that equals either our net income or our net loss. The statement of owner's equity, this informs users about how much of the earnings were kept and reinvested in the company, and it shows the changes in the owner's capital for a specific period. The statement of owner's equity is prepared with beginning capital plus owner contribution plus net income or minus out net loss for the period. And then you subtract the owner's withdrawals, and that equals your capital. Your balance sheet. So your balance sheet provides valuable information that to a financial statement user about economic resources that the company has, assets as well as debits. The company owes liabilities, and it allows decision makers to determine their opinion about the financial position of the company. Assets equal liabilities plus owner's equity. And then your statement of cash flows. These are reports on a business's cash receipts and cash payments for a period of time. Cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. So how do you prepare financial statements? Financial statements are business documents that are used to communicate information for decision making. You have your income statement, the statement of owner's equity, your balance sheet, and your statement of cash flows. The income statement reports the net income or net loss of the business for a specific period. So here we see we have an income statement, and within this income statement, you've got the header, which includes the name of the business, the title of the statement, and the time period. An income statement always represents a period of time, for example, a month or a year. And then you've got your revenue. The revenue accounts are always listed first and then subtotaled if necessary. Each expense account is listed separately from largest to smallest and then subtotaled if necessary. And your net income is calculated as total revenue minus total expenses. Your statement of owner's equity reports how the owner's capital account balance changed from beginning to end. And so here we're looking at our statement of owner's equity. The header includes the name of the business, the title of the statement, and the time period. The statement of owner's equity always represents a period of time. The beginning capital is 0 because Smart Touch Learning began this month. Therefore, it had no beginning capital. And the beginning capital will always be the ending capital from the previous time period. The owner contribution and net income are added to the beginning capital. The net income is transferred from the income statement, and the owner withdrawal is subtracted from capital. If there had been a net loss rather than net income, this would also be subtracted. The balance sheet reports on the assets, liabilities, and equity of the business as of a specific date. So here we have our balance sheet. The heading again shows the name of the business and the title of the financial statement. Notice that the date is different. The balance sheet shows the date as a specific date, not a period of time. Our asset account, each asset account is listed separately, and then total cash is always listed first. We list those in liquidity, order of liquidity, the quickest to convert to cash. So cash is always listed first because cash is already cash. And then the balance sheet must always balance. So your assets must equal your liabilities plus your owner's equity. Your liabilities are listed separately, and then total liabilities that are to be paid first are listed first. Owner's equity, the ending owner's capital is taken directly from the statement of owner's equity. Your statement of cash flows. The header includes the name of the business, the title of the statement, and the time period. A statement of cash flows always represents a period of time. Each dollar amount is calculated by evaluating the cash column. For example, collections from customers is calculated by adding the cash received from the customer in transaction 4 plus transaction 8. So the 5,500 plus the 2,000 gives us the 7,500. Our operating activities involve cash receipts for services provided and cash payments for expenses paid. Our investing activities include the purchase and sale of land and equipment for cash. Financing activities include cash contributions by the owner and owner withdrawals of cash. The ending cash balance must match the cash balance on the balance sheet. So we have another try it on page 23, and I need you to complete this try it as well for your in-class classwork for credit. So on page 23, it's try it. Page 23, try it number 18. So please complete that try it and send that to me as well. So our next objective is use the financial statements and return on assets to evaluate business performance. So how do you use financial statements to evaluate business performance? Return on assets, ROA, measures how profitably a company uses its assets. ROA is calculated by dividing the net income by average total assets. So we see here the return on assets equals net income divided by average total assets. And to find the average total assets, you take your beginning total assets plus your ending total assets divided by 2. And we have a try it. This is the last try it, fourth one, that I want you to do for credit in class. So on page 25, try it number 19. So complete that try it as well. This is the fourth one for class work. Complete that, and then I need you to send all 4 try-its to me to get credit for class for chapter 1. And that is everything. I do have some additional, as you see here, I have about 14 more slides. These are all in-class problems that we are going to work now. And these problems, you're not allowed to copy. You can't copy them. can't take pictures of them. They're not supplied in the PowerPoint that you have, the student PowerPoint, because these are very similar to what you will see on your quizzes, your midterm, and your final exam. But we are going to work these problems in class because I want to make sure that you understand how to work these problems. And it'll also give you a glimpse into what your exams are going to look like. So it should help you to better prepare. So I'm going to stop the recording now so that we can work through these problems.